Hello, and welcome back to another episode of Economic Insights. I'm your host, Alex, and with me we have a very special guest today, Selim, a market veteran of many years and the producer of our show. Welcome.
Hello, Alex. Happy to be here.
It was a very interesting week in the global markets last week. We have seen yields drop significantly, equity markets wobbled, the crypto markets lost billions in market value. How would you characterize these moves?
Well, Alex, there are only two words I can use to describe the sentiment: risk off. I am not a fan of crypto markets, as you know very well, but they offer hints into the retail investor sentiment, and it was not pretty.
But what was it that soured the sentiment so much? Is there one specific thing you can put your finger on?
Not one thing, but a combination of many things coming together is starting to show the cracks in risk assets. We pointed out the consumer sentiment drop last week. It's fair to say the rest of the market is catching up. We are switching to growth risks from inflation, and this is helping a reduction in longer bond yields, or help additional Fed cut expectations being priced into the yield curve.
Let's switch to the economic data. We had the PCE release. What did you make of that?
PCE release did not offer any big surprises. So, I do not expect the Fed to alter course based on this data. However, there are worrying signs on the spending numbers. January saw a decline in real consumer spending by 0.5%, which was larger than expected and the biggest monthly drop since early 2021. Alongside the consumer sentiment figures, this looks rather alarming to me. On the other hand, the trade deficit data was a big surprise. The deficit jumped by $31 billion.
Wow, that's a big jump. Are tariffs playing a part in this?
Absolutely. Companies front loaded their purchases before the tariff announcements. But there is another angle we need to keep an eye on. If the consumer cuts back on spending, how will the excess inventories be run down? US Economic Activity Surprise Index has also fallen sharply into negative territory. Atlanta Fed's GDP now figures show a contraction of 1.5% in its latest estimates.
Interesting and worrying. What was the market's reaction? Can you summarize for us?
Treasury yields have recently declined to their lowest levels since the autumn. In the front end of the market, an additional 28 basis points of cuts have been priced in. Equity markets, despite the Friday bounce, also feel on edge. The focus is definitely on weak growth now.
How is Europe faring in all of this? What has been happening there?
Perhaps the most important event was the German elections, that neither produced a surprise nor a conclusive outcome. While there is increased momentum for talk on debt brake release, there is little likelihood of immediate resolution in sight.
And in terms of the economic data, what was going on there?
We had the German and French CPI figures. The latter was softer than expected. German inflation figures were slightly stronger. However, there are signs of inflation cooling. Next week, we get the Eurozone CPI. Expectations are for a cooling in both the headline and the core figures.
And what does this mean for the ECB? They have their meeting next Thursday?
Yes, indeed, Alex. They are expected to cut rates by 25 basis points. Even though headline and core inflation projections are expected to be revised higher, I see no real market reaction to this. Unfortunately, economics seems to have taken a back seat given the geopolitical developments.
Considering all this, what are the foreign exchange markets concentrating on? Our listeners are keen to hear about the forex markets.
Lower yields have weakened the US dollar recently, but tariffs again took a center stage at the later part of the week, which helped reverse the trend. Japanese yen is being driven by the changes in the yield differentials. But as we approach the fiscal year end in Japan, repatriation flows will start to be more influential. This week, the eyes will be on the Canadian dollar, CNY, and Mexican peso as tariffs are expected to come into place. A peace deal in Ukraine would have been expected to push the euro higher, but it seems unrealistic to expect that, given what happened.
Let's shift our attention to the emerging markets, and Turkey has been making headlines. Positive ones. Tell us about it.
Yes, Alex, that's true. After months of negotiations, jailed Kurdish leader this week made a declaration that PKK, a terrorist organization, give up their weapons and declare ceasefire. The group did indeed declare ceasefire subsequently. We hope that this development brings peace to a region that has been plagued by decades of bloodshed. But from a market's point of view, A peace dividend that would improve the ratings of the current government also risks bringing forward an early elections agenda. This is all long term. More imminently, Turkish inflation will be announced this Monday, and also we have the central bank's policy setting meeting on Thursday.
Wow, busy week up ahead. Tell us more.
Let's start with the inflation. The expectations are for the annual inflation to come just under 40%. Disinflation is continuing slowly. Challenges remain. Ramadan always has an inflationary impact on food prices. Also, the strength of the economy is another obstacle to further slowdown. While the MPC is expected to cut rates by as much as 250 basis points, the CBRT will be acknowledging these risks. They may potentially signal a tougher stance of monetary policy going forward.
How about the global agenda? We seem to have a very busy calendar.
Yes, Alex, it will be very busy. We have the global PMIs to look forward to. We have the Eurozone inflation on Monday. On Thursday, we have the ECB as well as the Central Bank of Turkey rate setting meetings. Tuesday is the day where tariffs for Canada, Mexico, and China come into effect, the same day that Trump addresses the Congress. But the most important data point is on Friday, the non farm payrolls.
Oh, yes, the big one. What should we expect there?
The market consensus is for solid jobs creation to continue. Unemployment is expected to stay low. While the recent headlines about government sector layoffs brought about some uncertainty, these are potentially small. The fact that the market's consensus view is for a solid labor report, this to me is a risk factor. The jobless claims were a surprise this week, jumping by 22,000 over the previous week. We need to see if this week the figures reverse.
This has been really insightful. Looks like we have a lot to talk about next week.
Yes, that's true. Great to be here, Alex. Thank you.
And we wrap it up here today, folks. Thanks for tuning in to Economic Insights. Don't forget to subscribe for more. Don't forget, folks, this is not investment advice. For that, please consult a professional. Until next time.